Well, not surprisingly, a number of clients and advisors have reached out over the last week. They want to know about how the market is responding to events in the Middle East, where we think things are going, and how we're positioning portfolios in light of events in the Middle East, and specifically in Iran and around the Strait of Hormuz. So that's what we'll talk about here in the next few minutes. First thing I'll say is that from a market standpoint, markets are actually holding up fairly well. If you look at the S&P 500, through Friday's close, the S&P 500 was down not quite 5% from its all-time high, so about 4.96 if we go unrounded. Since the conflict began, down about 3%, so actually holding up relatively well as a whole, although certainly there are pockets of weakness within the market in certain sectors. If we look overseas, international markets have struggled a bit of late since the war began, down about 8% or so. I think we talked about this last week. That's not too surprising considering that foreign markets are a lot more dependent on energy, and that's really the area that's feeling the most pain over the last couple of weeks. Now, what I find surprising and what many are asking about is the fact that traditional safe haven investments, think high quality government bonds, treasuries, gold, they're actually underperforming here over the last couple of weeks. They haven't really provided much protection at all. Treasuries are down about 2%. Gold, which is not held in our portfolios, is down about 5%. So there's a few reasons for this, but I think that generally this has been an environment where many are just kind of waiting for some clarity, and we're still in this fog of war, unfortunately. But why haven't markets sold off more than we'd otherwise expect? I think what we've seen over the last few years is that markets have actually shown they've been very, very strong, and they can handle these types of disruptions if they think that they're going to be short-term in nature. If you look at forward oil futures and the oil curve, that tells you what investors are pricing in as far as the future price of oil. We know that oil prices have been hovering around $100 a barrel, and this forward curve actually tells us where investors think the price of oil is going to be in several months down the road. And so what we see is that things are actually trending down, which tells you that in a month's time, 6 months' time, a year's time, they expect oil to be lower than it is today. Said another way, that means that investors expect this to be a relatively short-lived event. Another reason why markets are actually holding up is because fundamentals have been holding up. This is something that we've talked about, is that we're not going to get concerned unless we start to see fundamental conditions deteriorate. And here we see that over the last couple of weeks, the outlook for earnings growth among S&P 500s has actually risen. A lot of this has been from companies within the energy sector that are expected to have better earnings with energy prices moving higher. So not necessarily pricing in that pain just yet. The risk here is that if this turns into a prolonged conflict, we might start to see the earnings outlook start to deteriorate, the earnings projections start to move lower. That's something that we will keep an eye on, but I think this helps to at least explain to an extent why markets are holding up better than expected. Where do we think things are going to go from here? Obviously, we don't have a crystal ball. Unfortunately, we're waiting for more clarity just like everyone else is. But we are mindful of the fact that President Trump knows it's a midterm election here. He is mindful of the damage that a prolonged conflict can do to the chances of Republicans come November. Mindful that the affordability issues are something that's top of mind for voters already coming into this conflict. And we've seen that gas prices have moved about 25% higher over the last couple of weeks. Now, we also are mindful that if President Trump is looking for an off-ramp, he's only one vote. And we need to see countries like Iran, like Israel, also willing to pare back and look for some sort of resolution, look for an off-ramp. And so we're waiting here. I will say that over the weekend, as we start to hear more news about attacks on infrastructure and mines in the Strait of Hormuz, this tells us that it really reduces the number of off-ramps that are available and is a downside risk for us to keep an eye on. From a positioning standpoint, coincidentally, We have our investment committee meeting on Wednesday of this week, and so I'm sure it'll be a lively conversation. From broad positioning, one of the things that I would just remind listeners of is that we are managing based on a 12 to 18 month horizon. It is very tempting to do something in the portfolio when you are in this type of environment where there's so much noise being thrown at you. I think a lot of us, just to feel better and feel like we're doing something, want to make a change to a portfolio. It is our job to make decisions that are based on data and reason. And I think that's really what a lot of people look to us for. And so we don't want to get caught up in the noise. The hard part right now is that the range of outcomes are so wide on both sides. And so it's very hard to make a tactical move, a very short-term move with much conviction. Unfortunately, we came into this conflict with a neutral posture in terms of equity and overall risk exposure. So we're not overweight in terms of risk assets or equities. This is a good place for us to be. We're neutral. We have exposure here to stocks, and it's a healthy amount. It's not too much. And so if this is a short-lived event, which we expect it to be at this point, we expect markets to move higher. We expect to resume this trend that was already in place before the conflict began. So we're neutral on equities. We are diversified within equities. We've maintained a bias towards larger companies that have stronger balance sheets, are generally better able to weather these periods of short-term disruptions. We have an allocation to international stocks, which at least over the last couple of weeks have underperformed, but these are areas of the market that offer diversification. They offer less exposure to sensitive areas like artificial intelligence, which was a trend that was in place before this conflict began, where people were rotating away from that theme. Within fixed income, I mentioned that over the last couple of weeks, it hasn't really provided a lot of downside protection, but this is an important protection to have in place if this turns into a prolonged event. It's a nice hedge to have, because at some point the fear will become less about inflationary risks and more about a growth scare and the impact to overall economic growth, which would be a good environment for bonds. I will just say our approach coming into this has been all about diversification and a focus on quality, and it remains so right now. I think that's how we want to play this. We will maintain this positioning. Things could change ever so slightly coming out of this week's investment committee meeting, but ultimately our decisions are going to be based on data, and we're going to be thinking about, certainly beyond this conflict, what the global landscape looks like. So I'm going to leave it there for right now. If you have any questions, please feel free to reach out to your financial advisor. I'll look forward to checking up with you next week.